Credit means borrowing money with the promise to repay it later. It is a useful financial tool that allows people and businesses to access funds when needed instead of waiting to save the full amount. When you borrow money, a lender provides you the funds up front. In return, you agree to pay back the original amount plus extra, called interest, over a certain period of time. The borrower uses credit to buy things or invest in opportunities and agrees to repay the lender. The lender provides the money with the expectation of getting it back with some interest as compensation for lending. Credit is the trust that one party gives to another, allowing them to receive money or resources now and pay back later. This trust is fundamental to how lending and borrowing work. There are different types of credit people use. Credit cards let you borrow and repay repeatedly for purchases. Personal loans provide a fixed amount for specific needs. Mortgages are long-term loans to buy homes. Auto loans help finance vehicle purchases. Interest is the fee the lender charges for lending money. It is usually a percentage of the amount borrowed and represents the cost of borrowing money. Using credit wisely helps you build a good credit history. A positive credit history makes it easier and cheaper to borrow money in the future, opening up more financial opportunities.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.